Good morning. It's Terry Gardner from CJ Lawrence on Wednesday, February 26th. And after almost 150 consecutive written weekly market comments, I've picked a heck of a time to launch my first video. The topic of today's video is not going to be the coronavirus, but we do want to address it given its impact on equity markets. As I glance at my screen this morning, I can see that futures are up. But who knows what today's trading action will bring and what new headlines will be delivered. Coming into 2020, we listed a black swan event as a potential risk for an equity market that had performed so well for so long. Well, it looks like that black swan event is here, and it's called Corona. So what do we do now? Well, for starters, what we should not try to do is to try to time the market and try to figure out when to get out and when to get back in. Instead, at CJ Lawrence, we're looking across the valley and figuring out where we want to be positioned when the virus subsides. For sure, the depth and distance of the valley are unclear today. But we have conviction that if we own the right stocks, we'll be in good shape on the other side. Remember that if you bought the S&P 500 in 2009, as the worst financial crisis of our lifetime unwound, you would be up over 350% today in total return. And if you had bought at the worst point, the top of the market in 2007, you would be up almost 175% today in total return. So we think the message is clear. Don't try to time the market. This too shall pass. It may take some time, but own stocks of companies that will be the market leaders on the other side of this event. On to our other market observations. As followers of our work, you know CJ Lawrence for growth stock investing. But we also manage balanced and income accounts, and income is what I'd like to address today. The precipitous drop in U.S. Treasury yields highlights how difficult it is for income seekers to find meaningful income streams in today's market without taking excessive duration or credit risk. As an augment to bond positions, I'd like to highlight energy stocks, particularly those of the major oil and gas companies. Now, I'm bound to get pushback on this suggestion, since to some, fossil fuels are dirty words. But for those who believe that energy generation will transition towards renewables over time, and that fossil fuels will continue to play an important role in the global economy, albeit a diminishing role over time. In the intermediate term, select energy stocks generate meaningful dividends for those comfortable holding them. That's not to say that the stock prices won't come under further pressure. In fact, adding to the negative narrative is the fear that coronavirus-related economic slowdown will add inventories to already elevated crude inventory levels. But with most energy stocks priced near 15-year lows, now seems to be a reasonable time for income seekers to purchase some. But we would be careful to avoid the marginal players, particularly those with challenged balance sheets, and instead stick with the majors, with reasonable payout ratios and healthy cash flows. Some examples might be ExxonMobil with a dividend yield of 6.4%, Chevron with a 5% yield, Occidental Petroleum with an 8.7% yield, and Royal Dutch Shell with an 8% yield. Those are attractive yields in any market, and especially when compared to the bond yields even found in the high-yield bond market. That's our comment for today. Feel free to shoot us your questions and commentary, and I look forward to connecting again soon. Again, this is Terry Gardner with CJ Lawrence. Have a great day.